Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. Welcome to Bloomberg Brief. We're going to set your agenda.
Big tech soars on blowout earnings from Alphabet and Microsoft. AI fuels cloud growth. A brief spike in the yen turns to losses after the BOJ holds rates steady. And Anglo American rejects BHP's takeover bid, saying it significantly undervalues the company. Good morning, Manus.
Very good morning, Danny. It was a massacre in tech yesterday. $400 billion was wiped off the value of the NASDAQ. That was Meta. And then came the truth and reconciliation moment. People are spending on tech, on the cloud, in AI, at Alphabet and at Microsoft. And that has delivered a furious rally. Alphabet adding back $230 billion in market cap. We're going for a $2 trillion valuation on Alphabet. The stock you can see at the bottom of your screen. It rallied furiously. Dan Ives over at Wedbush. Rumors of Alphabet's demise are greatly exaggerated. $205 is the price target. We are going to get the PCE today. We're ticking down by a couple of basis points. I love what Bill Gross put on Twitter yesterday. The day the music died. Of course, he's talking about the yield at going towards 4.75. Why would you own bonds when you should own T-bills? There has been no intervention in dollar yen. We're going to spend a little bit of time on this. I would say that the Japanese are waiting to see what happens with the PCE and the Fed. We're now down to one rate cut from the Fed. Will that be washed out on the back of PCE today? 2.6%. That is the headline number that we're aiming for. Danny, good morning.
Good morning, Manus. George Saravelis over at Deutsche Bank just sending out a new note on the yen, saying that we think that the losses in the yen are warranted and that this finally marks the day when the market realizes that Japan is following a policy of benign neglect for the yen. Manus, he goes on to say, why would they intervene? Yen weakness is not bad for Japan. There simply isn't enough inflation. And negative real rates, they're great for the country.
You can still go on Poshco and get your apartment, your snow apartment in Japan. Much better value.
The dreams are alive.
Where dreams come true on Bloomberg Brief every day. Benign neglect. I mean, the point about it is whether you intervene in a currency unilaterally, unilateral intervention in of itself is usually quite impotent. You either need a trifecta, as we've seen from Janet Yellen to South Korea and Japan. It's either all in or no one's in.
Yes, but maybe enough shorts and you can really bully them around. But in the meantime, Manus, it's all big tech.
It's all about big tech. We bully big tech every day of the week. So the AI boost is coming through once again. Microsoft and Alphabet both showing confidence in their spending on technology and cloud computing.
In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24.
Alex Webb is with us now to start the conversation. Let's just dig into the Microsoft numbers first of all, Alex. I mean, it was a glowing report for Alphabet. Microsoft doing very nicely as well. And this is all about the commercial side. Just looking at some of the reports, the Azure product providing the clearest evidence yet of an acceleration and their leading position in AI.
Yeah, so AI very much the cherry on the cake, though a lot of the other businesses also doing very well. The cloud business, Azure, as you say, enjoying about a 35% growth rate in the quarter. Something like 7 percentage points of that were directly attributable to AI. So it's providing a real tailwind, starting to look like a real business. Don't forget that AI right now is the way they make the money is by selling the cloud capacity on which it runs. The AI itself isn't necessarily all that lucrative. It's the juicy margins, often sort of 85% gross margin you can get in the cloud, that is making this so successful right now for Microsoft.
And in terms of the cloud narrative, this is where Alphabet, as it were, re-accelerated. I like what Dan Ives wrote overnight, which was, you know, much has been made of Alphabet's demise. Let me just get you the exact verbatim, which is rumors of Alphabet's demise are greatly exaggerated. He's got an outperformance $205 on the stock. And this is about belief in the catch-up trade of Alphabet relative to their peers.
Yeah, I mean, look, there's a double punch on Alphabet, really, because you've seen a resurgence of the advertising business. That's certainly helped to an extent by the Olympics coming up this summer. That often provides a huge boost to advertising spending. Of course, the economy also picking up. That remains the lion's share of their business. But Google Cloud, for a long time, they've been trying to push it as the alternative pillar, the other leg they can lean on for growth, but it has been the laggard compared to Microsoft and Microsoft and Amazon, who are the market leaders in the cloud. What we're seeing now, of course, is that Google really is a leader in AI, despite some of the issues with Gemini in the past. And so it is starting to be quite profitable itself. The market had been expecting something in the order of $600 million in profit from Google Cloud. In fact, they've sort of blew that out the water with $900 million in profit. So AI is actually helping Google to start making real traction in the cloud space.
And Alex, I mean, all of this just stacks up, I think, to show how maybe poor Meta's earnings were in retrospect, especially when you have someone like Snap, kind of the laggard in the advertising space, the one that seemed to not have it together, having such a blowout quarter.
I suppose the challenge is, of course, with Meta is that the expectations were extraordinarily high. The stock had more than doubled in the past year. Google, Alphabet hadn't enjoyed anything like that. Snap, of course, is often seen as a bit of a second-tier player when it comes to both social media, and then the advertising business that comes along with it. So that does, of course, mean that you don't have to change very much. You just need a few wins at Snap, and actually it can make quite a big difference quite quickly. The thing that a lot of people have been attributing the gains at Snap to has been direct response advertising, where you see an ad in the app and then you're invited to provide your email address or click through and actually take an action. That seems to have been where they've made a lot of headway. And the one thing Snap has that's a little bit different from some of the competitors is they have an audience which isn't all that easy to find elsewhere. Sort of young, pretty influential audience, trends-making audience, which is on TikTok to an extent. But Snap will say that they have a safer platform than TikTok.
Yeah, I mean, we're the young and influential audience in this house. It's got to be said, actually, as well. I mean, you said we very, very carefully.
I said we.
I mean, I'm always hopeful.
Are you on Snapchat, Manus?
No, actually, I think I might have tried. No, I haven't tried Snapchat. I've thrown mud at pretty much everything else. I'm not too bad on TikTok. I hope they don't ban it. Right, let's...
He's a TikTok star, actually.
TikTok star. Don't forget the buyback and the dividend at Alphabet as well. I mean, that was one thing which I should have mentioned at the start of the show, which is welcome to the club. Talk to me about Intel, because again, it is about the forecast, and that remains challenging at Intel.
Yeah, the thing is with Intel, at least sort of technologically, is they're having to work very hard to sort of stand still, right? Their competitors were early movers with extreme ultraviolet lithography technology. That's really the bleeding edge that's used to make the tiniest, most efficient chips. Intel was a slow mover on that. Now it's starting to catch up, and it's pivoting more towards a foundry business, or expanding its foundry business. That's when you make semiconductors from designs from other companies. So, for instance, NVIDIA and Apple, they design chips, but then they commission TSMC to make them. Now, that pivot is still not complete. They are still working very hard to ensure that they have all the EUV, extreme ultraviolet lithography, capacity that they need, but also to build out that foundry business. And it isn't moving quite as quickly as I think investors would like.
Alex, we appreciate it. A huge week for tech. Alex Webb wrapping things up. Manus, let's get to some of the other top stories now that are trending on the terminal this morning. More tech for you. Elon Musk's AI startup, xAI, is close to raising $6 billion from investors. The funding round would value the company at $8 billion. Sequoia Capital is said to be one of the investors participating in the deal.
Chinese shopping platform Meituan eyes Riyadh as the first stop in the expansion beyond China. Now it plans its debut of a food delivery platform in the Saudi capital, competing with Delivery Hero and Uber. The move comes as Saudi Arabia looks to increase investments in tourism.
How about a little bit of Remy Cointreau at 5 a.m. in the morning? Shares are up after saying it's seeing better demand for its pricey cognac in China. Remy and other premium spirit producers have been seeing weak sales in the region and the U.S. following the pandemic-era boom.
Coming up in the show, we're going to talk a little bit more about the Bank of Japan as yen breaches 156.50 and change.
And we're going to bring you an exclusive interview with Blackstone's global head of credit and insurance as the firm hunts for its next $1 trillion.
The asset-based finance market, which is a much larger addressable market, $25 trillion or higher, is a very large opportunity for us. And given our scale and our size, with about $420 billion on our platform in credit and lending at Blackstone today, it gives us this really unique position to take advantage of what's happening.
It's Bloomberg Brief. I'm Danny Berger with Manus Cranny in New York. So, Manus, we got a BOJ decision where they've stood pat. They did tweak some of their language on bond buying, and this is the results. We blew past 150 without intervention, 155. Now we're through 156.57. Is this finally the time?
I did like what your note that you had from
George Servalis. Yes.
That's at Deutsche Bank,
exactly.
isn't it? Which is benign neglect. But
yes.
Here's the thing. When is the right time for the Bank of Japan to pull the trigger on intervention? We've had verbal intervention. We haven't had any cash put into this market because the risk is this. For as long as dollar rates remain high and the dollar remains resplendent, are you just throwing good money after bad if you step in and intervene now? That would be the counterfactual.
Especially literally now when we're going to get US PCE
exactly.
later. Why would you do that if we could see a stronger dollar? Well, let's get to our guest on this. Joining us now is Camille de Courcel, head of European rate strategy at BNP Paribas. Camille, great to see you. So we have this BOJ decision, and before it, you did write that there's a strong case to remain short rates at the front end of the Japanese market. What is that case at this very moment?
I think that view is still unchanged, but we would certainly wait for a bit of a retracement in rates. I think after the dovish statement from the BOJ, the dovish delivery from the press conference as well, rates have room to go a little bit lower, and then it will be time to re-engage with shorts at the front end, because overall I would say that our view on the BOJ is unchanged.
So a dovish narrative from the Bank of Japan, therefore, does that unleash the bears on yen? I mean, do you expect no intervention? Can they tolerate a materially lower yen again, really?
I mean, I think the reality for the currency is that indeed the BOJ or the government cannot entirely control it. It's mostly driven by the US economy. So FX intervention remains a risk, but I think that the reality is that any intervention would likely have a short-lived impact on the market, because at the end of the day, what would be more impactful for the currency would be if we start seeing inflation in the US decelerate, or if we start seeing the US economy finally start turning a little bit. But that's not at all what we are seeing at the moment. Yesterday's GDP report, again, was not really in this direction. So as we go into the coming months, and with the BOJ probably on hold until September, or at least that is our view, the currency is more likely to remain driven by the US.
Well, not even just the pain for Japan, Camille. It's a problem that the world is grappling with a strong dollar. We saw that clearly at the IMF. We saw that with countries like Malaysia, Indonesia having to step in to defend their currency. But when it comes to the EU, Manus and I spoke with Jane Foley on Monday, who said Europe would welcome a weaker currency. They would welcome the growth that comes with that. Do you think that's right? And perhaps part of what's behind their continued declaration of independence and freedom from what the Fed does?
I think for Europe, it might be a little bit different. I mean, in terms, for example, of currency for euro-dollar, we don't really think that the euro can break below 106. The reality is that if you look at the latest PMIs, what we are seeing finally is signs that the Eurozone economy is starting to rebound. We have the same signal from the UK economy. So we could start seeing a shift from the investors' perception towards Europe, which until recently has always been that the European economy is much weaker than the US. In fact, we are now seeing in the rates market, if you look at euro rates yesterday, we had an impressive sell-off. which for us is justified by many factors, including inflation risk premia, which is rebuilding higher with the geopolitical tensions, but also the supply factor, which is still important for the term premia, and which could still push rates a little bit higher as we head into June, when we have a peak in net issuance across G3 economies. So euro rates have been a bit slower for sure than the US in the latest repricing higher, but we are finally seeing some catch-up on the back of the economy, but also on the back of inflation. And when it comes to inflation risk, for the Eurozone, the US development are certainly something to keep an eye on, because what we have seen between the US core CPI basket, if you remove the items which are not included in the Euro core CPI basket, what we have actually seen across this cycle is a very strong co-movement. So what's happening in the US right now, and this reacceleration of inflation, is certainly highlighting the cautious ahead for the ECB and for rates market as well.
And that caution, Camille, will it change the narrative for you? You still say that June is a rate cut event in the East for the ECB. Again, we move to this new narrative, which is perhaps one and done for the Fed in December, and one and done at the risk is one and done by the ECB? Or do you still see incremental cuts in addition to June and that divergence perhaps accelerating?
Yeah, so indeed, I think June is pretty much a done deal. The latest communication from the ECB is certainly guiding us towards that. Even the most hawkish members are still talking about June. I think one good reason for that is the fact that the last hike, the September hike, was delivered as an insurance against the potential of upside surprises to inflation. That risk didn't materialize. So it looks to us like the ECB is pretty keen to unwind it. But once June is done, I think there is a clear question, clear uncertainty as to what the ECB is going to do next. Having said that, we still expect a quarterly cut, September, December for this year at least. But the risk is certainly towards less cuts or just delayed to cuts, similar to elsewhere.
Camille, appreciate your time this morning. Enjoy the rest of your Friday and your weekend. Camille de Courcel of BNP Paribas. Man, it's a quick check on what the mega cap giants are doing this morning, and they are up. It is a diverging fortune between Meta and the rest of them. I think the interesting thing here is they're all spending so much on CapEx, but the difference between Meta and the rest of these is that there's a clear path to monetization and to rein in costs.
Think of it also as well. What is your tolerance for moonshot lab businesses inside these companies? And there's a very, very clear narrative here, because Alphabet and Google, they also have moonshots as well.
Yeah, but one of them is search, another one is Ray-Ban glasses.
There you go. There's the differentiation. So it's about which level of moonshot ability are you prepared to tolerate. Anyway, $400 billion worth of a tech bloodbath yesterday, and Alphabet gives a dividend and a buyback. Go on, Alphabet. She's up $230 billion and counting. Bloomberg Brief. It's Friday. We got you there. I'm Manish Cranny, Danny Berger. She didn't break anything. I've tried. Let's have a look at the front pages for you. This is what's making headlines around the world. Of course, Secretary Blinken's on his trip to China. He meets with President Xi in Beijing. The US diplomats wrap up their 3-day visit. Now, the final conference, Danny, came after 5.5 hours talks with the Foreign Minister Wang Yi, and that covered a wide range of issues, including China's support for Russia, according to the US State Department. Tense times, certainly with Taiwan and the hot war between Ukraine and Russia.
Yeah, well, on the front page of the New York Times, Manus, former publisher of the National Enquirer, rather, David Pecker, testified that former President Trump thanked him for bearing his scandal with Playboy model Karen McDougal days before he became president in 2017. He recounted this conversation to the jurors in a Manhattan court Thursday. Those trials for Trump still ongoing, Manus.
Yep, they certainly are gripping the streets of Manhattan. Now, The Journal leads with this. This is about Donald Trump and his allies quietly building support, preparing support to blunt the Fed's independence. There's nothing new in the story in of itself. It's been mooted many, many times. Yes. But the former president, we understand, if he got elected for a second term, a number of proposals are on the table, including incremental policy changes and even the assertion that the president could play a role in setting interest rates. I don't think there's anything prophetically new in this, in that it has been mooted before, but I think it's the scale of potential change at the Fed. I think that's the essence of the Journal story.
But also, if we kind of go through the intellectual exercise of what would happen, we know Trump likes lower interest rates. He's said it very frequently. You get a cut in interest rates at a time inflation isn't tamed. That sends higher end rates higher at a time when the government is issuing an insane amount of debt. That is a toxic mix.
Absolutely. Look, in the article, it talks about he could be consulted on rates. He should play a role. He should be seen as almost as a quasi-effective appointee. It should be just said, and there is a statement from his team where he says, let's be very specific, unless a message is coming directly from President Trump or an authorized member of his campaign, no aspect of future staffing or policy announcements are official.
From our global headquarters in New York, I'm Danny Berger with Manus Cranny. Let's set your agenda.
Big tech soars on blowout earnings from Alphabet and Microsoft. It's AI that's fueling the cloud growth. A brief spike in yen turns to losses as the Bank of Japan holds the line on steady rates. And Anglo-American rejects BHP Billiton's takeover, saying it significantly undervalues the company. Well, that was expected, wasn't it? Danny, good morning.
Good morning, Manus. It was, and look, we're expecting more, maybe more bids, more conversation. We'll get to that shortly with our guy, Johnson. NASDAQ futures, Manus, up 0.8%. It was the magnificent duo that came to save the day, that got the market's groove back. AI, it is clear that those bets are paying off, that the spend is perhaps worth it. Meanwhile, U.S. 10-year yields, U.S. 2-year yields, there we go, switching it up on you. U.S. 2-year yields, little change this morning, but yesterday we did breach 5% at one point after that GDP reading that had elements of a hotter economy in it, of hotter inflation. We're going to get PCE later today, but the PCE within the GDP, that was also higher than expected. Finally, the yen, Manus, that is also weakening this morning by 0.6%. The action this morning has been weird. Around 4 a.m., we had this huge spike of strength in the yen. That quickly peters out as it becomes clear, as George Servelis over at Deutsche Bank puts it, we are now in an era of benign non-intervention from the BOJ. So the BOJ is not going to save the day, but Alphabet and Microsoft will, Manus.
Absolutely. After a $400 billion wipeout, go on Alphabet, adding back $230 billion and going for a $2 trillion valuation. But it's interesting that you talk about what's happening with the Bank of Japan. This is the very essence of catching an FX market by surprise, which is just when you think that there's no risk of intervention. But the question is, how much latitude will the FX, how much latitude does the Bank of Japan and the Ministry of Finance really have? They really are testing the patience. We had Finance Minister Suzuki, again, warning on a weakening in the yen. So it might be benign for now, but benign can turn into something very aggressive, as we know, as we both know.
Yes, no, it's true, but this is the problem, is that in order to solve the weakness of the yen, you don't need intervention, you need to fix the interest rate differentials. But for the Bank of Japan, what's the impetus to do that? Ueda said...
Well, that's a hell of a wall to climb, isn't it, against the Fed?
No, Ueda also said our long-term interest is like, inflation is likely to be 1.5%. Doesn't seem like a reason to hike.
Give him a call.
My Japanese is lacking, although he speaks excellent English, so, I just feel guilty. Okay, anyway, Manus, to the tech story.
Earnings.
The latest earnings out of Alphabet and Microsoft. Saving the big tech rally, Alphabet is on track to add $230 billion in market cap, which, by the way, if it does, it will become bigger than NVIDIA. They had a blowout result bolstered by AI and cloud demand.
We are very pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base.
Let's bring in Bloomberg's Tom McKenzie for more on this. Tom, I mean, it is a clear story of diverging Mag 7 from Meta to Microsoft and Alphabet. But starting on Alphabet, I mean, this was a huge beat. And not to mention, they're turning into a dividend company now.
I know, isn't that remarkable? Coming out with their first ever dividend and the buyback as well, an additional buyback, $70 billion US. They've done buybacks before, of course. It is the dividend, as you say, that is the first that they've ever come through with. So that's really interesting. This is a cash generative business now with the growth added onto that. And what's also really interesting is that the cloud part of the business used to be the black sheep of the family when it comes to the Alphabet story. They only broke even last year in Google Cloud. This time around in this quarter, you're coming through with profit of $900 million US for Google Cloud, well above the estimates. The AI play, all that investment is now paying off for Alphabet. And interestingly, of course, the key driver still of revenues for this business, search, still performing well as well. YouTube, search and Google Cloud all coming together for a glorious trifecta for Alphabet. But really interesting, it's the outlook that is pinned to Google Cloud that's going to be of most interest. As you say, this could be a company that's looking to add, what, 230 billion to its market cap, as Manus was saying on the back of this. The investments around AI paying off for Alphabet.
And for Microsoft, Tom, good to see you this morning. You're right, that dividend was a lovely shot in the arm for Alphabet. On Microsoft, again, it's about the evolution of investment to monetization in the cloud.
Yeah, and when you read the analyst notes and reactions to this, you can almost sense the sigh of relief. Because, of course, these companies, both Alphabet and Microsoft, are investing double-digit billions every quarter in that AI infrastructure. Microsoft, of course, with its significant investment in OpenAI. But again, evidence in these results that those investments are paying off. Whether it is, of course, the Azure cloud, where you saw a 30% increase in profit, above the estimates, well above the estimates. And by the way, within that 30%, 7%, they said, coming from AI and that AI demand. They're able to charge a premium. Their enterprise customers are willing to fork out extra. But it's not just the Azure cloud that is, of course, a key driver for Microsoft, but it's also GitHub, that coding platform, underpinned again by OpenAI, coming through, but also Copilot as well. So for you and I, there are people out there, there are customers out there, individuals, but also businesses willing to pay an extra $30 a month for that AI-infused Copilot. All of that coming together for Microsoft as well, suggesting that, again, the spend on AI is also working for them.
Yeah, and then, of course, the magic sauce for all the central banks is at what level does AI really kick in with a productivity boost, if at all. Just go and have a little bit of a read around some pretty interesting stuff, questioning the gargantuan assumptions on AI and productivity. Tom, thank you very much. For now, we'll take it as a win, turning the tech bloodbath around. Now, Anglo American, this is the mining company. The board, they're unanimously rejecting $39 billion takeover proposed by the industry giant BHP, saying this: it significantly undervalues the company. It is seen as being opportunistic by the Anglo chairman. Guy Johnson is with us. So, Guy, I don't think anybody's deeply surprised with this rejection, but how long does the dam of rebuttal hold up? Good morning.
Good morning, Manus. As you say, it's not a surprise that they're rejecting it, but I think you've got to look into the deal and figure out exactly what is going on here to get to grips with the complexity of what is happening. And the sense seems to be that because of that complexity, shareholders in Anglo probably want some sort of a cash element to this deal, and that cash element needs to be quite significant to compensate for the risk around the transaction, and probably the overall number needs to be higher as well. Because remember, at the moment, what is being offered here by BHP is an all-share transaction, and that doesn't seem as if it's going to get the deal done. So let's talk a little bit about kind of what this is all going to look like and the complexity around it. There is, first of all, the price. But actually, I think probably the price is secondary to the complexity. So the complexity comes from a number of different fronts. First of all, there's the regulatory complexity. I suspect regulators around the world, including in China, will be taking a look at this deal. But actually, it's the South Africa question that really kind of raises a bunch of red flags. First of all, you have significant holdings in Anglo, in South Africa, from state-owned, from basically state-owned pension funds, and they are likely to resist this sale. You've also got the unions in South Africa. There's also the issue of Kumba and Amplats, which are two businesses that are listed in South Africa but are majority held by Anglo American. And many shareholders currently probably would not be able to hold those as standalone entities were they to be spun out. So the complexities just go on and on and on and on. So basically what we've seen today is an unsurprising rejection. Basically what shareholders are saying in London is, if you want to get this deal done, you are going to have to offer significantly more money. You're going to have to offer us a whole bunch of cash rather than just shares to compensate for the risk of the deal not getting done. You can do all that, maybe this transaction can work, but you've got a long way to go, BHP, to make that happen.
Surely, though, Guy, this just opens up the floodgates. If there's a view into a split-up Anglo, a cherry-picked Anglo, that others are going to come in and say, hey, we want that. That's our goal, to have this huge holding in copper and all of these metals at a time when they're so needed.
You're right, Danny. Everybody wants the copper bit, but it's the complexity of the other bits that provide the problems. And the shareholding that exists, particularly out of South Africa, in this business that provides the problem. So everybody's going to face the same challenge. It's not just BHP. Everybody's going to face the same issue. I wonder whether others can find a way around that may make it easier. But for instance, if Rio Tinto came out with the same sort of structure and offer, it would face the same problems. And it's interesting as well, we come back to the price too. There is a rising copper price right now, and it was interesting in the statement that was released this morning by Anglo, they suspected that maybe this offer doesn't fully reflect the future value of the business, and maybe the copper price this morning does speak to that as well. The fact that copper is going higher maybe underlines rather than undermines the fact that maybe this offer does need to go higher, but I think it's the structure of the offer and the complexity around it that's the real problem.
Yeah, I mean, that is one heck of a tight market, and you've got a number of houses. I mean, it's above $10,000 for the first time in 2 years. BlackRock, Trafigura, all calling that higher. It's interesting that you've got the South African pension fund, the state-owned pension fund, which is very reluctant at the moment to go with this deal. So it'll be interesting to see at what price of cash and stock, that combination, that they might be tempted in on. Look, does this say something more about the London market, the state of the London market? We sit here in New York, you're at home in London, and we talk about the differential in terms of the depth and liquidity of where people want to list. It's an ongoing debate. But for the miners, it's always been a bastion and a home of listing, hasn't it?
Yeah, they call London Jurassic Park because it has so many of these old school industries that are listed here. But here's the thing, Manus. We often talk about the multiple arbitrage that exists across the Atlantic, i.e. US companies trade on a significantly higher multiple than European companies at a much higher multiple than we see here in London. And we'll come on to dark trades in just a moment. But if you compare and contrast, and you can see this because many of these companies are dual listed in Australia and London, you can actually see it within an individual company. The fact that the Australian part of the business is listed at a higher multiple than the London part of the business. So it's amazing. It's not just kind of separate companies. You've actually got it within a company. You can see that arbitrage existing. So that's part of the problem. If you're a London-listed miner, you are trading at a discount, even to the Australians down under. But there's another company that I want to fold into the narrative here, Manus, and I'm glad you bring up London. Darktrace this morning has agreed a deal with Thoma Bravo. Now, Darktrace was recently listed in London. It was a tech company. It was seen as one of those big names that might provide some sort of a catalyst for London to get a little bit more exciting, move away from being Jurassic Park. It is going to be taken away from Thoma Bravo. It's going to be taken out by Thoma Bravo, the private equity company. And the logic here is just amazing. Basically, the sense seems to be that what Thoma Bravo is simply doing here is going to be to take this company private for a couple of years and then list it in America and get a higher multiple for it. And it's as simple as that. It probably helps that Darktrace doesn't carry much debt and actually has some cash, so you could probably gear it a bit. But it is that simple. Thoma Bravo is going to come in, take out Darktrace, hold it for a couple of years, stick it in its back pocket, a couple of years' time, nice little IPO in the States, much higher multiple, much higher valuation. And these two stories, what's happening with Anglo and what's happening with Darktrace, just speak to that discount that London currently has. Does that start to unwind and does that start to improve?
Guy, thank you very much. Wrapping up, we'll track this deal and let's see how it shifts. Guy Johnson there with the BHP bid for Anglo. Airbus stock fell in trade this morning. First quarter results significantly short of the estimates. Again, Guy Johnson back with more. He caught up with the Playmakers CEO about guidance.
We've indeed released our Q1 numbers. We've delivered 142 commercial airplanes in the quarter, which is 12% higher than last year. So in terms of production deliveries, we feel we're on track, and that's very important. The quarter is indeed a bit soft, but it's again on track with our expectations to keep our guidance unchanged for the year. We are building indeed a lot of inventory. We're operating in a complex and difficult supply chain environment, and we want to make sure that we have the resources, that we have the hardware, the equipment, and everything we need to keep ramping up in a year that will be backloaded, a bit like what it was last year.
OK, so we're going to see more aircraft deliveries in the back half of the year. There's a line, Guillaume, that stands out from the press statement, and it's right at the top, and I think it's worth repeating to the audience. We delivered first quarter 2024 results against a backdrop of an operating environment that shows no signs of improvement. Geopolitical and supply chain tensions continue. Guillaume, why are you still dealing with supply chain issues? Many other industries face these kinds of problems during the pandemic, but they are long in the rearview mirror. Why is aerospace still struggling with these issues? Why are they so hard to fix? Why is the supply chain not being sorted out more quickly?
Yeah, Guy, it's a very important question. Actually, we are in a long-term industry. We employ people which are highly skilled and qualified, and a significant number of the workforce of the people left the companies in the supply chain at Airbus with other companies during the pandemic. So we are rehiring people, but it takes a lot of time to onboard them, to train them, to give them the qualifications, and to have them at full speed. And this is a bit across the supply chain. But there is
Airbus CEO speaking with none other than Bloomberg's Guy Johnson. Okay, coming up, I'm going to bring you my exclusive conversation with Blackstone's global head of credit and insurance as the firm dubs him the $1 trillion man. Context matters here on Bloomberg. Welcome back to Bloomberg Brief. Danny Berger and Manus Cranny in New York. So Manus, as you may have known, I had a late night yesterday. I was in the office for a while having a great conversation with Blackstone because they have set a goal to grow their credit assets to $1 trillion over the next decade. In order to do so, they've made sweeping changes atop the unit. Gilles Dellaert, he's the new head of credit and insurance at the fund, says that Blackstone can coexist with banks. They're turning to lending markets, while the industry does face diverging fortunes as rates stay higher for longer. Dellaert spoke with me exclusively yesterday.
Ultimately, what we do, we're always going to coexist with banks. We're great partners to them. You saw us announce in Q1 a number of partnerships with Barclays, with KeyBank, real win-win situations where what we brought to the table was highly complementary, solved a need for them. And I think you're going to see us do more of those types of partnerships.
But it can't all be buddy-buddy. You're competing with them at the same time.
There might be situations, but for the most part, look, we borrow from them. We pay them a lot of fees. We see opportunities from them, and we source risk from them at large still. Certain borrowers will sometimes come to us directly, and that's what you'll see, and that's what I think ourselves, as well as some of our competitors, have gone through. But ultimately, we don't think that this is a model where one needs to beat out the other. There's enough opportunity to finance broadly defined all these markets and coexist with one another in a very structured and constructive way.
So the IMF wrote a paper earlier this month, and you will not be unfamiliar with their hypothesis at all. The idea being that private credit remains untested, but untested in its current size. And not necessarily that it poses a systematic risk, but to the individual investors who've invested in perhaps a bit more risky, but over-leveraged and illiquid and non-transparent type assets. Do they have a point?
Look, I would say we probably see it slightly nuanced or different way. Lending in itself is not a risky thing. If you have the right protections and you do the right loan level underwriting work. Our performance ultimately speaks. If you look at our default rates, we've seen zero default so far this year in our private credit portfolio over the last 12 months. In our non-investment grade portfolio, where we finance over 2,000 companies, we've seen less than 40 basis points. That's a fraction, 90% lower than what you see in the public market. So if you have the right expertise and you position your book defensively, and that's what we've done into this cycle and this environment, you can persist. You may see some bifurcation of performance, and you've started to see a little bit maybe early in Q1 in some of the BDCs. You've seen some slightly more elevated default performance in the lower middle market. Where you invest ultimately matters. And so our focus has been, we like to finance large companies that are better positioned to weather the cycle. We like to finance them in sectors that have strong tailwinds, where there's strong growth, high free cash flow generation, sectors like software, business services, the energy transition or renewable energy arena. And if you do that well and stay away from things that are maybe more capital intensive or cyclical in this part of the environment, then you build a resilient portfolio, and that's what we've done.
But at the same time, we've had a Fed that, by all accounts, is shifting gears. They're getting ready to go higher for longer. And a lot has been made in this environment about a maturity wall coming in 24 and 25. I understand that your portfolio, you feel is safe, you're not concerned. But for the industry as a whole, does that maturity wall all of a sudden look a lot steeper and a lot more dangerous?
I think there's less leverage in the system than there was in prior parts of the cycle, right? If you look at pre-GFC, financings were being done at 65, 70, 70% plus LTV. Today, in our direct lending business, we're financing large companies at 40 or 45 LTV. So you're starting in a very different environment than you were maybe back then. On rates, I would say, look, rates being high has been a tailwind for credit allocators. They've been able to earn high risk-adjusted yields, which has been a good thing. Will that invariably put pressure on certain businesses? Absolutely. We're seeing that. We're seeing the economy slow a little bit. We're seeing inflation be more sticky. The pace of this inflation slowing. Eventually, the Fed will cut, but they'll be deliberate about the pace and they'll be measured about it. And we've invested at Blackstone in credit for nearly 20 years now, through high and low rate environments, through cycles that were both, challenged or less challenging. And ultimately, performance speaks, and that's how we've built our business.
What happens, though, if we don't get cuts this year or next? Presumably, there's going to be some pain in the industry, and is that pain you could take advantage of?
I think that there's going to be opportunities. We're getting ready. We're in the market with our opportunistic fifth vintage fund right now to get ready to be a capital solutions provider. Invariably, certain companies will need a bit more runway, will need a bit more of an extension of, say, their first lien unitranche paper. They may need a piece of mezzanine debt or preferred security. So we're getting ready for that. I don't think you'll see a massive slowdown. But you'll see a slowing top line and bottom line that we've kind of started to see play out a little bit here as we sit here today. So we're getting ready for that, but it's not necessarily going to be a recession type that we've seen, in the GFC of the likes. We think it's going to be more measured.
An exclusive conversation with Gilles Dellaert of Blackstone. We'll have more of that conversation throughout the day here on Bloomberg. It is Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. So Manus, we have Blinken in China right now with President Xi. And just a little bit on what we learned from their meeting.
I mean, this was an hour ago,
yes,
so it's
correct.
just a quick recap.
Yes, exactly. So Xi had said during it that the U.S. and China should avoid what he called vicious competition, Manus.
Yeah, and look, they should be partners and not rivals. Again, really trying to reaffirm. Yellen was there just a few weeks ago, but more on that later. It's all about, there's only one number that really matters. It's PCE on the headline, 2.6. And the core...
What about the core? Do you have that number? I don't have that number.
The PCE, it's going to be plus 0.3%.
I don't have my notes in front of me, Manus. You can't test me like that.
That was a deliberate... Anyway, PCE, you see, I just think that she's symbiotic with me.